Surging inflation and interest rates are driving house prices down, but the question is, how far will they fall? So in this video, we'll look at the factors driving prices down and up, and we'll consider at the end of the video a forecast for the UK, but also for the US housing markets. This video is sponsored by Private Internet Access, which lets you securely access content worldwide across all of your devices. So let's look at house prices and how far they're going to fall in a bit more detail. Let's start off by looking at the global picture. And really, whichever country you look at, if you look at a basic measure of expensiveness of houses, such as the price to income ratio, almost everywhere is looking quite expensive. Really, the distinction is between very, very expensive, as in Australia and Canada, and just very expensive, like the UK and the US. You can see that all four of these countries, based on this measure from the OECD, are at the highest price to income ratio there's ever been. Now, until recently, if we broke it down by US city, and these are the Case-Shiller indices for the US, essentially every single city was simply moving up at an incredible rate. It's only recently that we've seen these numbers start to turn over. And here I've used US recessions, those are the blue bars, to show you the aggregate average house price for the US and how rapidly it's grown. So in the 80s it was at 6%, in the 90s at 4%, in the 2000s at 7%, and in the 2010s at about 3%. However, after the very brief pandemic recession, house prices in the US have increased at a staggering 17% per year. Now clearly that's unsustainable because it's growing much quicker than wages. And as we saw, the price to income ratio is that expensiveness measure. To get sustainable house price growth, prices have to move roughly in tandem with wages. The first factor which is driving prices down is inflation. Here's inflation for the US and the UK going back to 1988, and you can see that it's surged hugely recently, with the UK almost at 10%, it's recently fallen a little bit, and the US peaked at around 8.6% and it's currently at around 8.2%. Now the reason why that's pushing up interest rates is that central banks are raising rates in order to reduce inflation. But the direct effect of inflation on house prices comes via removing money from our pockets. So it reduces household disposable income because we're spending more on things like groceries and utilities. And less disposable income means we can borrow less when it comes to a mortgage. So with high inflation come higher interest rates, and that also has a negative effect on house prices. Your mortgage rate will be relative to the risk-free rate, which is set by your central bank. So whether that's in the Euro area, the UK, Australia, US, or Canada, you can see all of those policy rates, even the ECB, have been increasing sharply recently. And for example, if we look in the UK, if we look at the 2-year fixed rate mortgages, depending on how much of the value of your house you borrow, ranging from 60% of the value of the house up to 95%, all of those interest rates for a 2-year fix have been surging recently. And that's because the Bank of England's policy rate has also been surging, pushing them up as well. That was data till the end of September, but if you actually look in October, rates have increased even more. That's because these 2-year fixes and 5-year fixes will be based on the swap rate, which is another interest rate layered on top of the risk-free rate. And the 2-year swap rate in sterling has been surging. So you can see that in 2021, it was just over 2% for a 2-year fix, and now it's above 6%. So that's almost a tripling of the mortgage rate. And if you're fixing your mortgage for 5 years, that'll be based on the 5-year swap rate, and that's also increased hugely to just over 6%. Now in the US, you're very fortunate because you can fix your mortgage for 30 years. But even in the US, we're seeing that 30-year fixed rate surge upwards to almost 7% over a very short space of time. And that was from a low of around 3%. Now, fortunately in the US, you don't have to move house. You can just stay where you are and you won't have to worry about these rate increases. But for first-time buyers or people who are forced movers, maybe you're going through a divorce, then it can be very painful when it comes to remortgaging and having to pay a much higher rate. Before we move on to talk about affordability, let's say you wanted to access the internet to look at your bank account or maybe arrange a mortgage. How could you do that securely and also access your home account, even if you're anywhere in the world. Well, one way to do that is with private internet access, which is a VPN. This is what the control panel looks like, and it's really easy to use. You can just choose the server which is automatically chosen for you, or I could choose a server from anywhere in the world, or indeed from any of these 50 US single state servers. But let's just choose Southampton, and we just click the big green button, and now our connection is completely secure. If you're based in the US and you want to access your home state as if you were still there, let's say you want to catch up on local sports or local news, well, you can do that with those 50 servers located in each of those states. Viewers of PensionCraft get a special deal where you get 3 months free private internet access, and then you can get 82% off a 2-year deal. And that comes with a 30-day money-back guarantee. To learn more about that, just go to the link in the description below. For those that need a mortgage, affordability is hugely impacted by higher rates. So if we look at mortgage repayments as a percentage of gross household income, this is for the UK, you can see what happens to that percentage as you increase the interest rate. So currently we're roughly at 6% for the 2-year rate, as we saw, also for the 5-year fix. And that translates into mortgage repayments, which are over 25% of household income. That's roughly where we were in 1991. So this is a completely different world from the one we were in just a year ago. And particularly for first-time buyers, this affects your buying power. So imagine you've got a fixed income. If you can borrow a multiple of your disposable income, then there's a certain amount of money you can borrow at a fixed interest rate. So if interest rates are at 2%, maybe you could borrow $193,500. But then as we gradually dial up the interest rate, notice that the amount you can borrow reduces dramatically. So for example, at 5%, you've got 28% less buying power. And this is for fairly reasonable assumptions about buying an average priced home in the UK. So by making many properties unaffordable, that means that sales simply won't happen and prices have to fall. And if we do the same kind of analysis in the United States, so this is for a 30-year fixed mortgage, but here I've used the median sales price of a house, which also varies over time, you can see that the debt servicing cost has gone up hugely, from just under $1,500 at the beginning of 2020 to almost $3,000 in Q3 of 2022. Another negative factor is slowing wage growth. Now, because prices snap back to a price to earnings multiple over the long term, just as they do for equity, they fall back to the average price to earnings multiple, the sustainable rate of house price growth is set by the rate of wage growth. And here is UK wage growth going back to 2000. Notice how there's a break in the rate of growth which occurs during the global financial crisis, where nominal growth fell from 4% to about half of that. And if we look at real growth, it decreased from 2% down to almost zero. In other words, wages were only just keeping up with inflation. Now, during this period, house prices have been increasing by much more than 2%. And that's why affordability has gone down over time. And if you look at the end of the series, you can see that there's been a sharp move downwards. That's because inflation's been growing much more rapidly than wages. Comparable data for the US shows a slightly higher nominal and real growth rate for wages, but again you can see that recently there's been a massive dip downwards as wage growth simply hasn't kept up with inflation. Now, negative real wage growth means less affordability and lower house prices. Now, I promised there'd be a positive, and this is it, and that's rate insensitivity. Now, interest rates only affect that segment of the UK house owning market where people have a mortgage. And it turns out that about a third of the dwellings in the UK are owned outright. In other words, there's no mortgage at all. In fact, there are more houses which are owned outright than those owned with a mortgage or a loan. That only makes up 28% of the dwellings. It certainly hasn't always been that way. If we look back in time, you can see that the two lines crossed each other roughly in 2013. That's when the houses which are owned outright exceeded the number of houses which are owned with a mortgage. But if we go all the way back to the early 1980s, about a third of houses were bought with mortgages, and about a quarter of them were owned outright. So any people moving house who own their house outright are obviously going to have a much smaller mortgage or no mortgage at all. And for these people, rates can do whatever they want, they really don't care. So that's why I think it's most likely to affect the lower end of the market, which is what first-time buyers usually buy. At the higher end of the market, we'll get a lot of these households where they own their house outright and they have lots of equity. Now let's turn to the UK price forecast. Our approach is very simple. We extrapolate the average income in the UK. That's something which gradually increases forever. The central case is the red line, and then we have a best and worst case. And then in the panel below, you can see the price to income ratio. Now that is mean reverting. It tends to snap back to its long-term average. And that's why the central case here is falling. The best case simply surges up beyond all reasonable price to income ratios. It throws care to the wind, and the worst case is sharply mean reverting. So if we extrapolate income for the UK, I get income growth of about 1.3% per year. And if we extrapolate the central case for price to income, I get a fall of 0.8% per year. Combine those two, and our central case is price growth, which is not big, it's just 0.5% per year. We also get a worst case of minus 5% per year, and that combines the worst wage growth with the worst mean reverting price to income ratio. And we get best case growth of just over 5%. But for the UK, we can also come up with a really pessimistic outlook based on the price to income ratio, which is suitable for the bank rate that we're about to move to. So in this top panel, you can see the price to income ratio, and in the bottom panel, you can see the bank rate. Both of these go back to 1920. Now, UK home ownership really kicked off in the 60s, so I don't think the data before that is really applicable. But what you can generally see, even in the 1940s, is that when interest rates were very low, price to income ratios increase. And the same is true since 2000. So now if we plot the Bank of England policy rate here on the x-axis and the price to income ratio on the y-axis since 1960, we're currently here, the big red dot, with a bank policy rate of 2.25% and a price to income ratio of 7 times. Notice what happens as you increase the bank rate is that the price to income ratio falls. And if we go to say 6% for the bank rate, that's what many people expect, the price to income ratio falls from 7 all the way down to just under 5. So assume income growth of 1.3%, but this time the price to income growth is absolutely huge and negative. It's minus 31%. And those combine to give price growth of minus 30%. As I say, this is a worst case, so it won't be this bad. My guess is that it would be something like 15%. That would be much more likely. Now let's look at the US forecast, and using the same approach, the income growth would be just under 3%, a bit better than the UK. Price to income growth would be slowly decreasing in our central case at 0.7% per year. Combine the two and we get a central case of 2% house price growth, with a worst case of minus 3% per year. That's with the worst wage growth combined with the worst price to income ratio and a best case of over 6%. In conclusion then, I think the pain's going to be greatest for those who have to move house or for those who are first-time buyers. And that's because these people will be most affected by increasing interest rates. But I think that's going to affect the lower end of the market. For people who are cash buyers, those people won't be affected by higher interest rates, and I suspect that part of the market will not be as badly affected. But certainly in the US, there'll be a huge cushioning effect because people can just stay put if they can, and that way they'll be rate insensitive. And to a lesser extent, rate fixes will help people in the UK, where you can fix for 2 or 5 or maybe even 10 years. So people will just have to hope the rates come down by the time they need to refinance. So there we have it, a fairly gloomy outlook for the US and the UK housing markets, but I wouldn't get too worried about it. Remember, you can always stay in your house for a longer period of time in case you're worried about negative equity. Prices do eventually recover, and the drawdown periods are never usually more than a decade. But, is it going to be a complete collapse? I doubt it, because there's still an undersupply problem both in the US and in the UK, and that'll keep a kind of floor on prices, I think. Now, don't forget our offer from Private Internet Access. You get a link to that in the description beneath me. And, as always, thank you for listening.